Assalamu Alaikum everyone, welcome back to another video. I hope you're having a great day. So in today's video, we're going to look at growth stocks. I was having a conversation with a friend of mine, and we were talking about the stock market and what's been happening in mainly the growth side of things. And he was basically saying, oh, things are difficult at the moment, blah, blah, blah. And I was just thinking, do you know what? It might actually be worth looking at the companies that you own, companies that you do not own at the moment in the sectors that you are down at the moment. So for example, if you bought a couple of those high-tech companies and you're down at the moment, what could you do? Like, what is your long-term plan? And we're just talking about generally everything. And then I've realized, you know what? There are companies within the tech sectors that are doing absolutely brilliant job. They have excellent free cash flow. They're doing really well, especially in the cloud side of things. Okay, that are really undervalued at the moment. So I just thought, you know what, let me put a video together. So even though this video I planned it a long time ago, I just thought, you know what, let me bring it forward because I was planning to do it in basically next week. So I just thought, let me just share this with you guys tonight. But before I get actually started on literally the video, what I want to say is it takes a lot of time to research on the information. So I have a couple of websites that I use, companies like a Morningstar, where I basically pay subscription and I actually use it to research a lot. So when I talk about, for example, companies being undervalued, I'm looking at Apple at the moment. So undervalued, overvalued, and what it is, and like how much, if it has, a moat and all of these things, right? I get it from these websites, and what they do is they use basically a discounted cash flow model to figure out basically all of this information. So instead of me to do like every time they have a new earnings out doing this myself, I thought, you know what, let me just use this and then I can just share that with you guys. So it takes a lot of time and effort, to be honest with you, to put these videos together. So I would really appreciate if you can just press the like button, because I'm basically bringing information from different places, bring all of that in one place. Okay, so it was easy to understand and easy to basically digest all that information in one place. So if you're enjoying these videos, just like and subscribe to the channel. Apparently, according to YouTube, 50% of the people that are watching the videos are not actually subscribers. So I would really appreciate if you can subscribe to the channel if you haven't already. And thank you very much for those who have already. Thank you. I really appreciate that. Now, the definition of growth stock is basically growth stock is any share in a company that is anticipated to grow at a rate significantly above the average growth for the market. Now, every time you invest in the stock market, especially as a stock picker, your goal is to beat the market. Okay, so basically that's your goal. So in order to beat the average growth for the market, you need to find companies that can beat the market. Otherwise, what's the point of investing in the market? Okay, that beat doesn't have to be just the capital gains. It could be dividends as well as capital gains. So growth stocks are those companies expected to grow sales and earnings at a faster rate than the market average. That's number one. The growth stocks often look expensive, trading at a high PE ratio, but such valuations could actually be cheap if the company continues to grow rapidly, which will drive the share prices up. So sometimes you're paying high multiples. So companies have to have high multiples because of the growth attached to it. And for that reason, because the price will appreciate, you obviously get your returns and even better. You beat the market basically. Okay, and obviously they don't pay any dividends. And growth stocks are often basically put in contracts with value stocks. Value stocks, yes, they're great and so on, but at the same time, I don't like comparing it like for like, because you can be a value investor and still invest in growth companies. Because value investing to me means finding companies that are way undervalued and cheap at the moment. And that's basically what we're going to do today. We're going to look at the 5 different companies in the cloud sector that are really undervalued at the moment, that could, or maybe not all of them, but some of them are undervalued at the moment, that could potentially be a great addition to your portfolio, or maybe you already have them and you can add to it, or whatever the case might be. Okay, that's what we're going to do today. So the first company that we're going to look at is Snowflake. Snowflake is basically a cloud-based data platform in the US, and they currently don't have any PE. the future growth for the next 1 to 3 years is expected to be about, for 5 years, sorry, is expected to be almost to 60%. The future return on equity is at the moment in negative. And I think this is a lot to do with the fact that the company has not made any profit yet. Okay, so once they start making that, they'll probably your return on equity will be better. But at the same time, this information came from simply Wall Street, and they actually do not think the stock is undervalued at the moment. So that could be the reason. Okay, so they have a target price. So if you look at their recurring revenue, they don't have a recurring revenue, just like the companies that we looked at in the cybersecurity. This basically means, do these companies they have customers that are loyal to them? So subscription based, basically, that's what it is. So do they have a subscription based? So about 97, I think, or 96% of their revenue actually comes from non-recurring revenue. So for that reason, I put no here. Current ratio is basically what we're looking at here is debt. Okay, so they have enough. If it's above 1, they have enough to pay their debt. So that at the moment, that's absolutely fine. Okay, then you've got revenue growth, 124%. So this company is actually new. They actually, in terms of the IPOs, I think it was only 2020 or 2021 they IPO'd. And also one of the biggest investors in this company is actually Warren Buffett. So he must have seen something great in the business itself. But 124% growth, that I think is going to drop in the next couple of years. I don't think they can sustain that. They don't have a competitive advantage at the moment, so any other company can copy what they're doing and do it better. According to Morningstar, this is according to Morningstar, by the way, this part here. So according to Morningstar, their valuation at the moment is fair valued, and it's 3 stars. And the target price is $295 per share. And as you can see, they're currently trading $253 per share. And when you look at the valuation in simply Wall Street, you're looking at about 60. So basically, it's way overvalued at the moment. So they're saying it's 67% overvalued at the moment, and it's $166 per share from 200. It has to drop almost $90 or more to actually hit that target price. So it's really overvalued at the moment. So in my opinion, this is a great company, but I think at the moment I would not actually purchase this personally, because I don't think it's the fact that it hasn't got actually any competitive advantage, as well as that it's overvalued. That's basically according to simply Wall Street. Maybe if it drops below 150, maybe I'll look at it again. But I like the business model, and I like the growth in this business in the long run. But at the moment, I don't think it's a buy for me. So I'm going to pass this one. So the next one is Salesforce. Salesforce is a company that I own in my portfolio. It's currently trading. It's basically one of those businesses where they work with other businesses to help them grow their customers. So they look at their data. So they store their information in the clouds. Okay, they also look at their company's management systems. They look at how many customers they've gained, what basically to do, how to advertise. They analyze their data, the revenue, everything for the business. Okay, and they help a lot of business grow there. But right now the PE is 122. That is very, very high. Remember, Snowflake actually didn't even have a PE, but these guys actually do. They're profitable business. In terms of the next 1 to 3 years growth-wise, future growth is about 21%. That's very good for a growth company. We're looking at about almost 10% of future return on equity. Recurring revenue, absolutely. All their businesses actually are recurring, because that's like ongoing. Once you subscribe to their business model, they have Slack, they have other businesses they've incorporated into their actual business. Okay, they don't grow organically as well recently, meaning that they don't actually they actually purchase other companies to add to their portfolio. So they're not coming up with new products. They actually buying other businesses that they think will fit into their own portfolio. And Slack is one of those companies. I can't remember how much they paid, about I think $20-something billion I think they paid for Slack. Current ratio of above 1. So again, that's all we want. But this is just above 1. So that tells us they have a quite bit of a debt. And then revenue growth. Okay, by the way, when it comes to current ratio, we're looking for anything above 1. That means they have enough money, if it's above 1, enough money to pay off their debt in the next 12 months. Revenue growth, we're looking about 24%, and then it has a wide mode, which is very good. They have a competitive advantage, so they're better than the companies in that sector, if you like, or that industry. According to Morningstar, this is a 5-star stock now. Can you believe that? Right, 5-star. That's how cheap it is, right? Currently trading $222 per share. Morningstar is expecting to grow this to $320 per share, according to Simply Wall Street. Again, 23% undervalued, $286 per share. Now, that's still massive upside, and the fact that it's 5-star, that tells me it's a very, very cheap business. I do own this stock. I'm definitely adding to it next week. So as soon as basically tomorrow, I'm definitely going to add to this. On Monday, I'm going to start adding to this business because I genuinely love the business model. I like the fact that they have a wide mode. I like the fact that they grow in their business. They buy in other companies, organically grow in their business. So yeah, absolutely adding to this business. Okay, next couple of weeks. And then we have Adobe. Okay, another company that I own. Currently trading $518, slightly pricey. Okay, when you look at the price here, I hope they do split soon. Again, you don't have to worry about these things. You can buy a fractional shares these days. You know what Adobe does, Photoshop and all that stuff, and the Creative Cloud is absolutely brilliant. The business is growing. I mean, there's more people. They're now even talking about the metaverse, and then all these NFTs and all of that stuff will possibly be used. Adobe product will be used to create some of those NFTs. Again, I don't know how that's going to work, but hey, that's basically one of the things they're talking about. The PE is quite high, so 51. Again, when it comes to high growth businesses, you're talking about high valuations, high multiples, that's what I mean. Okay, future growth about 14%, return on equity about 41%. They definitely have a recurring business because as soon as you buy their product, you're in it, that's it. Next month you have to subscribe again, so you just basically keep paying that subscription every single month. Current ratio above 1, which is very good. Revenue growth of 23%. Wide mode, absolutely 4-star, 21% discounted at the moment, and they're expecting the price share to grow to $630 by the end of this year. So that's quite a bit of an upside, which is nice. And then you've got valuations from Simply Wall Street about almost to 48%, and they're expecting $955 per share by the end of this year. That's some ridiculous valuations, but hey, I don't know. They actually use also discounted cash flow as well. So I looked at their model. It actually looks conservative, so I don't mind them as well. So this is the reason I use these two companies. Their discounted cash flow models are actually quite nice and easy to kind of understand, and obviously it gives you a margin of safety, if you like. But there's some valuations that I'm actually questioning about Simply Wall Street. But for this one, I agree. This company should be at least $1,000 per share. Okay, and I'll show you in a second how many shares of this business I own. So the next one we're going to look at is one of my favorite companies out there. Before you start thinking, how's Microsoft a cloud company? Well, look at Azure, whatever it's called, okay? Look at their cloud services. It's been growing almost 40 to 50, 60% every single year in the last 3-4 years. And it's actually growing faster. Morningstar, I think it said they expect it to grow almost to 70% next couple of years. So that's huge. So they have a massive cloud services. A lot of the business, smaller business actually are now moving on to their Azure cloud services instead of basically AWS, the Amazon one, or other companies. Currently trading $308. PE, lowest in the group that we've seen so far, and then 32% and 32. And then you got future growth of almost 12%. Future return on equity of 33%. They definitely have a recurring business. Obviously, they have products that they sell, and that's it. But the majority of the cloud services is actually recurring revenue, and current ratio of over 2%, basically 2, which is very, very good because we're looking for 1 and above. Revenue growth 13%. They have a narrow. In fact, that's not true. Let me quickly double confirm that because that cannot be true. I was on Morningstar now, so let me quickly show you what the evaluation is wide mode. There we go. So I'm going to correct that while you're still watching. okay, because that is not true. Okay, that is not true. So wide mode, that means they have a competitive advantage. They've got 4 stars at the moment. The price should be by the end of this year about $352 per share. Right now it's only $308. We went down quite a bit in the last few weeks. It's undervalued according to Simply Wall Street as well, 35%. The price should be 475, so it's slightly higher than what Morningstar are predicting. Regardless, whatever happens in the next 2 weeks, I'm definitely buying more of this business as well. So all 3 companies I own in my portfolio, and all 3 of them I will definitely be adding to it. I don't know how much and basically how often, but I will definitely be adding to them in the next few weeks. I'm going to start this week with definitely Salesforce, because that's the cheapest out of all of them. Microsoft, I own so much of it, so I might be doing a bit more Adobe before I do Microsoft, but we'll see what happens. Okay. Right, the 5th and the final company is ServiceNow. Okay, ticker simple now. Basically, they're very similar to Salesforce. The only difference is basically they also work, do the same, more or less the same things. They work into operators through. They have a platform called Now for workflow automation, artificial intelligence, machine learning, performance analytics, electronic service catalogs, as well as portals, configuration management systems, data benchmarking, encryption, and so on. So they have a massive wide range of products, and they have a massive quarters. They've basically released their earnings revenue a couple of days ago. I think the price went almost, I don't know, I can't remember, but it was very high. It was a day where everything else was down, so it was quite high, I can remember. But they've done really well in terms of their quarter. Currently trading $561 per share. PE almost 500, which is very laughable, but hey, it's what you pay for this type of companies. The future growth about 33, almost 33.5%, and then return on equity 30%, recurring revenue absolutely, current ratio above 1, growth rate almost 30%. They have a wide moat right now, discounted 4 stars. Okay, remember 1 star is the the most expensive. The cheapest is 5 stars. So the cheapest that we've seen so far in this group is this company here, Salesforce, and this is also a 4 star, 29% discounted, and then you've got $700 per share. That's the predicted, that's the target price, and then it's undervalued as well when it comes to Simply Wall Street, and then the price should be $667 per share. So yeah, so all 5 of them, apart from Snowflake, okay, they are undervalued. And to be honest with you, this company, yes, it has a great future, and I put it in this category because I think it will be one of those, and sooner or later. It's not going to be one of those speculative, because when you look at the companies that they work with, they've worked with a lot of huge companies. Okay, that's the only reason I've included in here. That's the only one that's a little bit speculative. But the rest of them, Salesforce has been around for a long time. Adobe, Microsoft, and ServiceNow have been around for a while, and they are growing businesses, but they are really high valuations. If you were going just by PE, you will probably end up buying Microsoft. But at the same time, when you look at their future growth and compare it into, so next 3 years, if you look at, for example, Adobe, 41%, and then you look at Microsoft, 33%. Okay, again, Microsoft is actually quite good, 33%, and then you got ServiceNow, about 30%. So yeah, you're paying a lot more for these kind of companies, but the fact that they're undervalued according to their cash, according to their revenue, according to basically their data, then there's no brainer. For me, it's definitely own. I don't own now yet, and don't think I would be adding to my portfolio yet unless it goes down massively again. And the only reason I wouldn't do it because it's very similar to Salesforce. Salesforce at the moment is very cheap. I believe in this business better than this one. So at the moment, even though they're both wide mode and they have basically a competitive advantage, I think I'm going to stick with Salesforce for now. But that's 5 different stocks that you could potentially pick from this madness that's going on at the moment. Okay. So if you look at, for example, ServiceNow, for example, is down just this month, is down 14%. Salesforce 12%. Okay, and Microsoft, you can see, is 9%. Adobe is almost 9%. Microsoft is almost 10%. So all of them are down quite a bit, and they've absolutely got beaten up Okay, but in a way that gives us an opportunity to buy more. So I've got 3.4 shares of Adobe. I have 5, I think, sales, I can't even talk, shares on Salesforce, but I also have a little bit more shares in here. Okay, so if I go to growth, I think I've got overall 10 shares, and I am down at the moment about 5% overall. But again, I don't mind that at all, because I'm definitely gives me the opportunity to add to this company. Okay, so as you can see here, I own 10 shares, £173 per share, and I'm down almost about 5%. So yeah, just to be transparent, that's what I'm doing. That's where I'm heading at the moment. So I'm definitely be buying a bit more of this company, see how it goes, inshallah. You know what, in the end of the day, I'm, like I've always said to you guys, I'm not a financial advisor, but I'm just sharing my basically progress. I'm sharing what I know already. And if you enjoy this kind of video, just give it a like, and subscribe to the channel. Tell your friends and families, anybody that is interested in the stock market. I hope you enjoy your day. Assalamu Alaikum. Take care.